The Atlanta Fed has the US in a recession for first quarter 2025. Just one lap, 14 years old. Time to buy Europe. Home Choice International. Budget take two. And where did that two-pot money go? This is Worldwide Markets episode 622 for 12 March, recorded on Tuesday afternoon. My name is Simon Brown, and this podcast is brought to you by Standard Bank Global Markets and Shift. Worldwide Markets, powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest forex rates. Thanks to Standard Bank and Shift for sponsoring. So let's kick off with Atlanta Fed, and they're truthfully a bit of a horror story in terms of what they are seeing. Now, to be clear, this is what they call a GDPNow data set. It is taking raw data and just dropping it into a formula and publishing it out. And they publish regularly. Next update will be on Monday. We have had two updates in March already. I think one on the 3rd and then one on the 6th of March. So late last week was the latest. There was a slight uptick, but they're still looking at Q1 2025 being minus 2.4% GDP. Now, this is not because the tariffs are directly hitting business right now. This is not because of cuts at federal worker cuts. This is not because of concerns over immigration or anything. Those will play out in time. We've had some of the Mexico and Canada tariffs already sort of walked back, but the issue is, and this is a tweet from Tom Robbins, a friend of mine, I've seen it in a couple of places, mid-Jan, Delta Airlines supply chain demand balance is as good as I can recall looking into 2025, pretty good visibility through the first quarter and into spring. He was bullish. And then yesterday, which was Monday, same person, the aerospace and defense, automobile, media, and entertainment technology industries have pulled down corporate travel, he said in a CNBC interview, and they are seeing a slump in consumer bookings. What we're seeing here is that uncertainty, and businesses are just like, we're not sure. Are we getting tariffed? Are the tariffs that have been announced going to be pulled back? How big will they be? Will they be for real? What about tariffs over there? It's that high level of uncertainty, and businesses are just, they're going into the lager, so to speak, and saying, we need to be a whole lot more careful. And that's the implication. I mean, the threat here is that often it's the worry, the uncertainty that leads to contraction and concerns, and rather than the actual reality, which will come in time. We don't know how bad it is going to be. We don't know how horror it can end up being. But at this point in time, it absolutely is being a horror, and it is impacting. And I think it's going to continue to do so. I don't think it's going to sort of suddenly fade away. We've certainly seen some significant sell-offs. Let me grab that there. Yep, there we go. Bitcoin trading 81,000. Nasdaq and S&P on Monday evening had their worst single days since, 2022. I mean, it's not actually that horror. You know, the Nasdaq is down a little over 10%, 20% is bear market, so this is officially a correction. S&P down a little bit as well, not quite yet 10%. This all in the last 4 weeks. And after S&P hit highs in Nasdaq as well. If we look at all-time highs just 4 weeks ago, if we look at some of the actual stocks, I mean, there's CrowdStrike. Now, the market was not obviously massively excited by their earnings, but CrowdStrike is down $160 from almost $460 down to $308 yesterday, again in just a matter of weeks. ASML getting the same level of pain, although ASML had been at much lower levels already. Nvidia down at just under 107. We're looking for, like, we're going to get a bounce, but Nvidia is going to bounce. In fact, Nvidia is going to go down another 3 cents. We've seen massive selling. Now, I've long said I think Nvidia can perhaps do 100 when DeepSeek came out. I thought it could go a whole lot down. On my little watch list here, the only stuff we were seeing green was kind of the consumer staples, Johnson & Johnson and those sorts. And we are seeing a market that is spooked, absolutely a market that is spooked by the threat of tariffs and all the other noise around the Trump presidency. That is the stark reality. I have said before that I think that President Trump probably watches the markets quite closely, certainly from his tweets and certainly in his first term. He seemed to watch the market. I think he's not going to like what he is seeing in the market. But does he walk it all back? I don't know that he does. But there's a bigger issue here, of course, and that is that a lot of trust has been broken. Trust that has been built up since World War II, since Bretton Woods, just after World War II. A lot of trust has gone. Trust with key allies of America, Canada, Mexico, Europe/NATO. All of those are, if Trump walks back everything tomorrow morning and says, okay, all bets are off. We're not going to fire people. There's going to be no tariffs. Everything will be cool. It will be, maybe strategic. Some tariffs, maybe on the likes of China. Some sanctions on Russia. Let's get proper peace in Ukraine. If he walks that all back in a moment and just completely does a U-turn, he's still got broken relations. Europe is still going to be like, yeah, guy, we still got, 3 years, 10 months of this. And with respect, we're not believing you for the next 3 years and 10 months. And who knows who comes in the next year's election? I mean, is it just, a Trump 2.0? It's just that level of uncertainty. And I think that is going to be the big schism going forward. And that makes me think, well, should we be looking at Europe? And I've touched on it a couple of times. I've been looking for an ETF. The obvious easy one is the Eurostoxx 50. There is a local JSE version from Signia, SYGEUR is the equivalent. And then I also found what they call it, hold on, let me go all the way up to the top there so we can actually get the name, MSCI Europe Industrial Sector. And I tell you what I like around that is, so here's the top 10 holdings of the one versus the other. The right-hand side is Eurostoxx 50. You can see it's ASML, SAP, Siemens, LVMH, Alliance, Schneider, Total Energies, whereas the industrial is Siemens, Schneider, Airbus, ABB, Rolex, Rolls-Royce is in there, BAE Systems. So it's a lot more focused on the industrial component. Geography-wise, they're pretty much the same. It's going to be France, it's going to be Germany, United Kingdom. But what's interesting is that the Eurostoxx 50 financials, 23%. Are they going to benefit from this? Now, why Europe? Because we've seen Germany announce a €500 billion package, which is partly infrastructure, partly energy, partly defense. They're saying that any defense spending over the 2% cap won't count towards their formulas and concerns. So we're going to see massive spend in the years ahead as Europe basically says, we've got to go it alone. Now, we can make the argument that Europe has been sleeping for the last 50 years or 70 years, whatever, drinking wine, pizza, cheese, croissants, etc. I mean, sure, that may well be the case. I think they're going to wake up. So the question is do you want pure industrials, in which case we're looking at this ETF on the left-hand side, or are we looking for just a broader Europe? And that's not an unfair shout in terms of, well, a broader Europe, which includes some IT, some tech, some healthcare, energy, but it doesn't include that much industrials. Whereas, top weighting here is financials. Whereas this one here, very much a case of, well, hang on a second, this really is all about industrials and that industrial spend. And I think we're going to see a lot of it. And a lot of it's going to be defense orientated. Absolutely, it will be. And you know what? You could go and find a defense ETF. Undoubtedly, there is one. But I think a lot of it is going to be broader than that. In Germany, it's going to be around energy. Germany's had a sick economy for a long time. France still has significant energy capacity, which they sell to other countries. Most of it is nuclear energy, of course. We know the story with the UK and the struggles that they've got. But it does suddenly start to say, hang on, is it Europe's time? Yeah, is Europe the ultimate value play, which is what someone said on my MoneyWeb show, Sean Kelly from Parity said on my MoneyWeb show on Tuesday morning. The ultimate value play is perhaps Europe. And he might well be right. I do that year-end presentation, position your portfolio, the power hour. I've been doing it now, I don't know, 10 plus years. And for years and years, I would have on there, this is Europe's turn. And I think it was 2 years ago, maybe 3 years ago, where I said, you know what, I'm tired of saying it's Europe's turn. I'm just going to kind of like, I think I put a piece of cheese on the screen, sorry to the Europeans. But if we go and look at what is happening in the Europe stocks, certainly we are seeing movements. The indices are happening. Now, a lot of folks are going to say, oh, we've missed the bus. Well, sure, but there's another bus coming. So there's the Euro Stocks 50 weekly chart come under a little bit of pressure the last couple of weeks. But I mean, there's FTSE. Just off highs, 2 tough weeks. Where are we? There's the DAX from Germany. Down this week, but nice run there. There's France having a really, really great run as well. Just got to all-time highs and then coming back a bit. Generally, the European indices, and especially if we compare them to the US indices, Europe is suddenly starting to look like, hey, there is something happening here maybe, and we should perhaps take account and get involved. You can do the individual stocks. I'm going to do an ETF. I'll probably get some of the Euro Stocks 50 in ZAR. I might actually put some of my tax-free, and then I will get some of the offshore, and I'll probably split them that way. The offshore one, I will focus on the industrials, and I'll get some Euro Stocks 50 locally. We have a Standard Bank Power Hour coming up end of March, effective offshore investing in US CITES tax. We're going to be talking around, for example, that one ETF we were looking at a moment ago. It's Irish registered, so you get a much better tax treatment for it. We'll go into all of that. We'll go the best ways to get to investing offshore, how you can do it locally in an ETF, how to get the money offshore. What about limits? Do we do ETFs? What about global and what about things, for example, all country indexes, which has got a lot more EM influence into it. JustOneLap.com/events for more information and booking. So the big story perhaps is, well, no, definitely a big story. Just One Lap, 14 years old. Well, today, as I'm recording, 11 March, we launched at an event in the JSE in 2011. I had an idea. I mean, I'd been working at Standard Bank online share trading. I'd been doing education for them. We were doing at our peak, I think we did 20,000 people attended our events across the country. But there was always the challenge of, I would go to Durban, Bloemfontein, Joburg, Cape Town, etc., Polokwane. But, how often would I go to any of the smaller cities? What about the really, really small cities? And I wanted something more online. There wasn't a heck of a lot happening at that point. And so I thought, well, let's launch Just One Lap. And, obviously you launch something, you expect it to be there in 14 years' time, but it's wild that it is. And it's a huge thanks to the team at Just One Lap. We're a small team. We're the contributors, back-end editors, etc. But an even bigger thanks to you, the folks out there who frequent it and make it happen. So, Wednesday, budget. Take 2. We try again. I was in Cape Town for the first budget, and well, we know what happened there. I got to say, my issue with the 2% VAT hike, and I get why the minister wants to do it. It's nice, it's easy. He can zero rate a few extra products, then everything will be easier, etc. I mean, that's all well and good. What struck me about the budget was it lacked imagination, for want of a bad word. And what I mean by that is that a 2% VAT increase is just easy. Why not get clever? Why not, cut waste? Why not say to departments, every single department has to find 2% of waste in the next 6 months to cut from their budget? That sort of thing. Where was some innovative thinking around the budget rather than just a VAT increase? Remember last year we took out money from the gold reserves because they hadn't been recalculated. That's fine, and truthfully we can do it again, right? Because we've still got money there, but again, it lacks innovation. It lacks thought to it. So are we going to get a VAT increase tomorrow or on Wednesday? I mean, I don't know. Is it going to be 2%? No chance. 1%? Maybe. Some people are saying it's going to be 0.5% every year for 3 years. I'm not sure that particularly solves the problem, but we will find out. Obviously, a lot more details will come through, but it's going to be messy. That is the honest truth. So some results out from a stock that I follow, but have always been concerned around liquidity. It is called Home Choice International. I'm interviewing the CEO on my MoneyWeb Now show Wednesday morning. So they started life, they were selling things online. At homeware, which is why it's called Home Choice International, I suppose. So they would be selling you things like, I don't know, curtains, bedding, furniture, and the like. And they were doing perfectly lacquer with it. They had a bit of a wobble, consumers under pressure. They've now got two fintech businesses in there as well. The one fintech business is Paid Just Now. They're at the likes of, I think, Game, Pick and Pay Clothing, Nespresso, and others, where you basically split the payment into 3 or 4 payments, no interest. They've also got FinChoice, which is sort of short-term 3-month loans. They do longer loans. They do funeral cover. They've been adding 100,000 customers a month. Their overall business actually did fairly well as well. Retail sales were up by 8.3%. The way that they manage their customers is that they're able to really, in a sense, kind of say, well, we start to know who the customer is. You come in via Home Choice International. They move you onto other platforms. They give you a little bit. You pay it back. They give you a little bit more. They manage it in that regard. It is not a expensive stock by any stretch of imagination. And it had some a really, really good set of numbers. What was it? Revenue was up 21%. HEPS up 27%. Dividend up 17%. It's sitting on a PE of 7.6. That's as of yesterday. So it doesn't include the current increase in headline earnings per share, which probably take that down to quick bit of math there, Simon. Let's call it 5.5 times. It's on a dividend yield of 6 and change, and that went up. So your dividend yield is now closer to 7%. The problem with it is it suffers from liquidity. Although I got to say, I think we've been seeing some better liquidity coming through there indeed. I mean, today we've done 4 million, but that, as you can see down here, is a big day for the stock. It doesn't usually do that level. There are days when there are 20,000 shares. There are days, I think, 268 shares. At the moment, the spread's also not too bad at 28.01 versus 29.49. A really nice little stock. I like it. The problem is liquidity, so hard to get in and out. And those sort of things, I would, put a cheeky bid in at 28.10 and see if someone will hit you or something. But, when that 28, the 228s go, which is only 4,000 value, so it's less than 100K, you're down to 25. I mean, it's that. It falls away so very, very quickly. And on the upside, same story. You go from 29.49 to 32 very, very quickly. It's traded today as high as 29.10. It's been as low as 28. It's a nice stock. What gets it moving? And that's always the challenge. The days of private clients such as you and I and others getting involved in pushing stocks, we all now in Nvidias and offshore, et cetera. So I don't know. It's a stock, as I said, I watched it in age. I really like it, but I don't know that I'm necessarily that confident on it. Quick last point on two-pot money. Where did it go? So in the exit surveys last year had been done by the long-term insurers, the providers. People were saying, we're going to pay down debt. Have they? Well, look, the bank results have been good and the impairments have certainly come down. But where did that money really go? Well, if we're looking at vehicle sales, if we're looking at Spur results, if we're looking at Sun International update, that's where the money was going. Folks were telling their long-term providers that it was for debt. But it looks like a lot of folks just then went and said, well, nice idea, but actually we want to spend it. Thanks for playing. We're not going to take it just yet. And that certainly seems to have been the response that we've seen. Folks have just been spending it. And sure, I mean, that's great, right? If you're in any of those stocks, you're looking pretty, but it hasn't gone to, I don't want to say responsible. It hasn't gone to debt. It also hasn't gone to Kira. I mean, Kira's bad debts also went up. It was largely spent. It was less money than we thought it would be, but it certainly largely got spent. Absolutely it did. Worldwide markets powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest Forex rates. Thanks to Standard Bank Shift Global Markets for sponsoring the show. We really appreciate that. We will leave it there for today. My name is Simon. We'll be back again next week, hopefully post-budget, hopefully post-no VAT increase. Until then, look after yourself. If you can, look after somebody else as well. Cheers all.